Yo, what is up, everybody? Starting a new channel here. I've been looking at a bunch of stuff with short-term interest rates and very quickly just banging out a bunch of stuff, kind of coming up with a model, starting to look at it and slicing and dicing it in a bunch of different ways. And I'm coming from this as a tourist. My background is just trading equities, so previously I was a bit intimidated by STIRs, and I thought there was no edge there because it was only traded by geniuses. But recently, I'm recording this in May 2025, last month was April 2025, Liberation Day. There was a bunch of dislocations, and I finally, somehow that kind of made its way into my awareness, and I started looking at STIRs, and I started finding some interesting stuff. So I want to share that, but it's kind of a lot to go over all at once, so instead of spending a bunch of time writing up an article or trying to do it all at once, I'm just gonna live stream or record, because I'm starting a new channel, what I'm doing in real time, even if it's fucking bad, and just put it out there, and then eventually it will congeal into some more comprehensible format. Yeah, so here it goes. Just a little bit of background. Here's what I'm looking at. Hang on, let me fucking change this. Hang on. So this is a STIR contract, short-term interest rate future. I'm just gonna talk like you've never heard of this before, because that's where I'm coming from. I didn't really look at any of this stuff until 2 or 3 weeks ago. I'm coming at it as a tourist, and so I'm just going to assume my audience is coming from the same place as tourists, so that's what I'm going to do. Short-term interest rate future, it's showing the kind of forward expectation of interest rates, and it's priced out of 100, so if you can see these numbers over here, 100 would be 0. And right now it's at 96, so that's pricing in about, 3.5% interest rate by this expiration, December 2025. There's way, 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 way more to it than that. It's actually a compounded interest rate for a 3-month window. I think it's starting at December 2025 and going out to March, but I've been a little bit confused about that, to be honest. And they trade in like a big, in a curve. Yeah, they trade in like a curve or a big table like this, so you can look at the rates and what they'll be out in the future. For example, yesterday these rates further out, like almost 2 years from now. This price went down, which meant the interest rate expectation was going up. In the front, it didn't change very much because as it gets closer to the present, it becomes more predictable. There's a little bit less of a surprise, or if there is a surprise, it moves very, very sharply. And then further out, people have no idea what's going to happen. So that's kind of a thing I'll get into later too, but from the stuff that I've been testing, my simplistic models, it's like 2 years out and further, you have a little more edge because no one knows what's going to happen. And then further, 2 years and further in, it's like a bit more competitive. This is basically the, if I had to summarize this in one thing, this is, I call this a spaghetti chart, but it's also called the hair chart. Yeah, basically what this is at this point in time, this is what people were pricing the curve as. Going to a little more recent past, this was COVID. So coming into COVID, people were we were normalizing rates off of the GFC. People thought, oh, the rates are going to go up, way further out. Then COVID happens, they drop rates to zero. Then people think, oh, rates will be very flat for a long time. Then they had to hike it. Actually, when I was looking at this on TradingView, which I'll show, people were expecting the rates actually to. Oh, this blue line is the actual fixings? I don't know. I'll show the TradingView chart, but it seemed like people were front running the curve rises, the rate hikes, like a year before it was happening. Then the Fed was slow to hike, and they came up. Then when it comes up, people think, oh yeah, it will be low. But then it keeps going higher. Then now it's up here, people think, oh, it will be up here forever. Then it comes down. Like, it's always just, people don't know what the future path will be. They're just basically always overreacting. So that's the overall. If you had to do it in a long-term structural edge, I would say that, just like, usually the longer end, I don't know if that's a real term or not. People say short end and long end, but I think sometimes they mean in the general curve, like treasuries. I don't know if they mean specifically with SOFR. But yeah, this is a lot of generic stuff I'm going over. Here's an example of just, this is June 2025 going out to December 2026, and then adding December 2027, but skipping the contracts in between 2026 and 2027. And this is 100 minus the price of the STIR, so it's showing the actual interest rate in the actual, number that it would be. And then I've marked out the round figures. So here's a daily chart. This line is like the effective overnight rate. I don't know if it's actually it's from Fred, but for some reason the first cut wasn't matching up for me when the meeting happened. But anyway, to show what I'm talking about, here was COVID. COVID started popping off, and actually as early as January, the rates started coming down really fast. So like, the rates were coming down probably at the same time as the market. I'm not plotting ES on here, but that's another chart I've been looking at that's very interesting and I want to model later. The rates go down, they go down to nearly zero. So this is like 2025 to 2026 as of 2020. So people, I mean, the rates go to zero, but people don't think they'll stay there. But they're actually pretty close there, which is, fairly unrealistic. But at this time, the world was blowing up, so who knew? As soon as the end of 2020, people were like, oh, this is causing inflation, the rates are going to have to go up, right? So 2021, the expected rates now, so here, we're saying, hey, wow, zero rates, maybe we'll have to get rates to like 2%, right? No, the rates are at 4%, 4.5% right now. So that kind of shows the underreaction in general. And then the Fed didn't actually start raising until 2022, so it's kind of interesting like this. And there's more and more kind of over and under reactions you can look at, like, they think, okay, well, maybe rates will get to 3. It keeps going, at this point in time. Then it keeps going. Then here you have the higher for longer era. So we're like, oh, well, they'll definitely have to come down from here, right? Maybe they'll come down to like 4%, right? Nope. If you plot ES on this, you can kind of see how it's interacting. When it's really far out, all of these longer end things are basically together because no one knows what will happen, right? But then it's interesting when they diverge. That would probably show more interest rate future uncertainty. And this was May 2024. Here we had the yen carry blow up, so this blow up happened. The Fed was still higher for longer. I can't remember. I think this end of July coincided with the meeting. So, and I remember the Fed cut basically after the yen carry blow up, but they may have been telegraphing that like a meeting before, like, hey, yeah, in the next meeting we'll eventually start cutting. But anyway, the carry blow up happened. The rates expectation were like, yeah, we're gonna have to cut now. It bottomed out here. The market was, ever since the low of the carry blowout, the market went up until April now. And the rates were going up, and so sometimes they're negatively correlated and sometimes they're positively correlated. That's something that I want to model out. It's pretty interesting. Yeah, and then here we have April. And so this is where I'm coming in as a tourist, and I'm like, hey, I think you can actually trade this, like, at least in times of stress, right? And the way I see other people trading it is they have an actual view using the, interest rate figures. Like here, when this blow up happened, I need to match this up to what actual contract we're talking about. So this is like mid 2026. People were thinking, oh, mid 2026, like we'll get back down to 3.5, right? Closer to, in air quotes, neutral rate. Then the blow up happens and people are like, oh, we're going to 3. They're going to cut to 3. Then I don't know if it was the market normalizing or people thinking, oh, but now we'll have inflation because of tariffs, so we're going to actually have to have rates higher. There's like a total kind of contradiction, conflict, dichotomy there. So it kind of comes back up and it's like, oh no, we'll have 3.5 again. Then as more economic data comes in, people are like, oh no, people are actually ordering less, like we're going to go into a recession. It goes down, 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 back to 3, and then just recently, I I guess we had NFP, we had some other economic releases, and it was like, oh wait, no, people are way overreacting to this, back up to like a more neutral thing. But at this point it's like diverged a lot, but that's also due to it coming closer to the expiration of these, where it will get closer to let me show this one. This is the like June. So we know June will be much closer to basically 4.25 or 4.5, which is where the range is now. Why is it less than that? Because, well, partially because it's a window. It's June going into September, and we think we'll get a rate cut in September. So this is a little more exact than we think. So this is 4.2, kind of either if you compound it or you average out the odds of like hike versus no hike versus cut. You get 4.2. And then in September, hey, we're thinking it's going to be 3.8. So this is like a much clearer divergence for a good reason. Anyway, I'm going to move on and start coding pretty soon, but this is kind of the background of what I'm looking at. Is the way I'm looking at similar to other people who are really good at this? Probably not. Again, because I'm a tourist. But I like looking at it this way. It's kind of like looking at this cross-section over time. But yeah, let's get more into the some stuff that we're looking at. I'm just going to close all of that. So I was looking in Bloomberg at a function called ECOS. It's the economic estimates. Different firms and different people submit estimates for different economic figures. It's kind of cool. There's a leaderboard and stuff. And ignore the formatting. It looks pretty schizo, but I'm just trying to. I started with a big, wide list, and I'm trying to filter it down to what's most important. But anyway, I want to pull a series of basically the real, what those numbers were versus people's estimates. You could just look at the plain numbers, and you could get that also from TradingView or Fred for free. But I'm going to use Bloomberg because it's cool. And basically, I just wanted to look at these numbers on a daily basis versus the futures and kind of see what's the impact of each one and quantify it a bit more exactly, and consider the surprise and stuff. Yeah, so I'm just basically prepping this information right now. This is kind of the stock stuff that I'm always importing. These are some functions and kind of lists I've built out, just utilities and random stuff that helps me handle this stuff. For these futures, I'm working with specific dates, and a lot of time I want to look at the expiration date, versus a meeting date or days to expiration. That'll come in use later because one of the models, the most simple model that I'm actually gonna, if I clean this up a bit more, I'll do a write-up on it, but it's basically pricing the stirs off of the OIS curve, overnight index swap. I don't know how I came onto that, but it seems to be not completely wrong. The edge is questionable though. I was looking at this backtest and it just looks like a beautiful curve, right? But the actual edge is like 1.5 basis points. And the ticks in these are like 0.5 basis point if you're in the US, 1/4 basis point if you're, within a few months of the contract. For other countries, the ticks are full basis points, so you'd have to you have to look at the order book for these. And the order books are really thick. That's a really cool thing about this stuff. There's like fuckloads of liquidity. So if you could actually come up with reasonable trades, this scale, there is some scale there, but getting in and out of it is like you would want to queue up in the order book and try to get a limit fill, unless it's moving really fast, in which case if you can take a bunch of liquidity in this and then have it tick up a couple of ticks and then get out, that's amazing. Anyway, I'm mainly focusing on, at first I was looking at all the G8 countries, but in my trading platform there's probably only 4 of those I can actually trade, so I'm focused on US, Australia, Euro, just a few of those. And I want to focus first on like NFP, CPI. There's some other ones in here I was looking at, I guess PPI, but I would look at all of them, but I don't want to just, I don't know, shotgun and overfit and do dumb shit like that, data mine. Anyway, let's see. I'll go like this. There was one of the reactions this week was based on ISM, which normally I don't hear people talking about, and it seems like the market will care more about these in certain times of stress. I think last month there was probably a day when the market moved like 100 points or something. Yes, moved 100 points off of the University of Michigan sentiment, which is like usually just the most inconsequential number ever. It's like a telephone survey, right? But in times of stress it becomes more sensitive to this stuff. PPI is probably the least one I care about. I'm a little more interested in PMI because I think Europe seems to care about that one a little bit also. And they also have it, so I am really interested in looking at these as a cross-section of countries. That's one of the interesting things about it to me. We'll get into it later. PCE, I always hear people saying that one is the Fed's favorite number, right? I usually don't see the equity markets caring too much about it, but yeah, there may be a bit of a divergence between what equity people look at and what people who are trading the actual these things care about. PMI, had that somewhere. I'm going to put this industrial production here. This, I'm not sure what it is. It sounds like it's balance of payments, sort of. Personal spending, I'm going to put that with PCE. And GDP. Going to put trade balance with that. Did I get this? I don't know why I highlighted this. Yeah, okay, so I'm going to just ignore the other countries and move on here. want to set this up later so I can shotgun a bunch of stuff. Cool. So I'll request this stuff, just daily prices, and I'll request this stuff. These are the fields I'm interested in. Okay, I had to pause and do some different stuff. This is kind of a thing that I do when I'm just checking out data. I just want to see, you know, how much of it is null and whatever. I'm not sure why it looks like this with the spike toward the end, but it may be because some of this stuff is not reported yet. I'm going to take a closer look. Most of this stuff is monthly, but some is quarterly. Yeah, so it looks like just this stuff at the very end is unreported. Because I requested May and it's not showing CPU. Oh, it's showing for the previous month, I believe. So potentially this is not matching up to the actual day on which it was reported. Which then would be really bad because it's introducing like a month's worth of look-ahead bias. Yeah, so here, for NFP, this was released yesterday, but it's indexed to the end of the month. Okay, makes sense. Doing some GPT technology here. Okay, this looks good. I'm just checking some of the recent stuff. looks like this one is right. I don't know what this is that I grabbed. Don't want to really look at it. I would rather move on to some other stuff. Yeah, this came in the other day. 2 days ago. Really? Yeah, it did. This one was -3 versus +2. -3. -2. Oh wait, the average was -2 forecast, and the actual was -3. These numbers seem slightly off, but I guess this is advanced. But the date matches up, so I guess for each of these I would have to really dig into it and kind of really understand the index, and like if this is adjusted backwards in time, which it could be. I don't know, I think there was some issue with like CPI revisions or some figure revisions. That's probably another data point, but yeah, I want to keep this basic. The point is to connect it to the short-term interest futures and look at what kind of has impact and what does not. The most important part was having it indexed to the correct day and not having a month of look-ahead bias. So I'm just going to bring this up so I don't forget about the whole point of this thing, data store. I'm going to get our expiration dates. Okay, now in df wide, here's the actual fun part. We'll look at the surprise, just last versus average, and we should contextualize that in terms of standard deviation, but it looks like it doesn't have all those if they're not reported yet. Okay, that's easy. These have a figure, but they don't have an average, so we could use the change versus last, but I don't know, I'm going to just focus on stuff that actually does have an average, because that's the stuff that people actually care about. So I feel okay dropping these. Some of these have a forecast but no price. That's a little concerning. That is more than a couple of them. It's all these PMI ones. Yeah, it's the actual PMI. Huh, okay. Guess I'll just ignore that one. Oh, these are 2022 though. That's a lot of them. Anyway, focusing, I'm going to do the surprise. So yesterday, what happened? Average NFP was 132. There were plenty of analysts. Standard deviation was 27, and it came in at 177. So it was a good surprise. hey, these PMIs have actual values. So there's like, oh, one of these PMI things is like ISM actually. So the NAP one is ISM. Could also be that this index changed, but yeah, it looks like this one it started in 2022. Then yeah, we have them in 2023. There's some infs in here because the standard deviation is 0. We'll have to deal with that. GPT magic. Just gonna trust that that worked. Okay, and then we have our stirs. So this is easy enough. want to look at how it reacted after. But also how it reacted going into it. Trying to think of the best way to do this. Well, I'll keep it simple and just look at the forward change and probably the change on the date. So this one. Okay, so now we have some really basic analysis. We want to keep in mind the reporting time of this. These figures are usually pre-market. Fuck, that's not it. I thought I requested the time, but yeah, I did, but it doesn't really come up. Okay, fair enough. Yeah, we'll just keep that in mind. Cleaning this up a bit for later. But anyway, this is just in general when NFP is a positive surprise. What happens to our specific stir futures? They usually go down. That basically matches with our idea of reality. Good NFP means rates can stay the same or go up. If it's below zero, which probably a lot of this was during COVID, you can just look. Like since COVID, there's only one little negative one. But it is the surprise, not the change. Yeah, the GFC. Yes, it's a little rare for us to have the negative. It's only in recessions or crazy periods. But I guess it's the surprise that matters more, not the actual change. So when we had a negative surprise, these ones went up, but then the long end didn't really do much. This is where we would also want to kind of look at it by days to expiration. So I'm thinking of how to do that. Guess we just join to this whole thing. Oh wait, I was going to just check real quick the DF forward. So this is the change on day. Since it's pre-market, we kind of can assume that it's actually affecting it. Then this was the next day return. So after this had been factored in, it happened on the next day. So this kind of shows a momentum effect, but this would show a mean reversion effect. But I don't know, we may also want to consider, did these all move in the same direction over this whole time? Basically, we're getting it more or less when the rates were coming down. So, or no, rates were going up. Our whole period is during basically rate hikes. So for stirs to go down makes sense. It's kind of like we're getting more of the trend effect here than anything else. There's another thing we can do. We don't have a lot of data points here. But yeah, when the surprise is more than a standard deviation, positive they go down. When it's more than under a standard deviation negative, they go up. If we take this, to 2, then we don't have many examples. It does look cleaner though. And at this point, I would kind of look at like, hey, in these big surprises, can we then go intraday and like kind of look closer intraday? My kind of assumption though is that this is fundamental data. So when you have fundamental data, the market should be able to price it better. And when you don't have fundamental data, then that's when the divergences and stuff are actually like tradable or something. So this is the next day when you have a big surprise. Hang on, I'm going to compare it to the actual movement. So big surprise down, big surprise up, they go down, big surprise down, they go up. The next day they continue down, the next day they revert a little bit. And then we can consider the trend, we consider this sample size. So if anything, I would distrust like this more, just because it's with the trend. There's some other stuff to look at. Potential to look at. Group it by DTE, so the things further out on the curve should have more uncertainty, the ones closer in should react more. The day before, did they do anything leading up to it? Consider forecast standard deviation, consider that. This is stuff I would look at, but yeah, I gotta think about how to best spend my time. I will look at the day before. So now we'll look at the difference, but shift it down by 1 day. I'm going to downsize this to 1. Actually, I'm going to start putting in some variables and stuff in here, and eventually what I'll do is put these in functions. Then I can look across the different economic stuff a little more quickly. Okay, so guess the previous data next actually isn't so great because these are pre-market announcements. I have to think about that. So let's say we have a pre-market announcement on this day. On this day, the change from here to here is actually showing the impact of the announcement. Then the change of this day is the reaction. Pretty dumb, but I'm just going to make a note to myself in here. So what do we have? Change on the day, which is actually the reaction. Change next day. So it's actually counting the impact. So this one's probably most important. Yeah, it's a bit confusing. Another way to go about this would be to look at this. then shift it by the days. Actually, shift. Trying to think of how to shape this. Right, I'm going to pause, take a break, and maybe hit up GPT for some ideas. Okay, I did a bit of vibe coding plus squishy human coding. I added the difference in price to this data frame, so now it's even wider. And ChatGPT came up with this code. And as a bonus now we do have days expiration in here as well. So now we can look at the difference by day, and we can look at the difference by the other thing. Yeah. I would like to melt this down though, so basically I want to get the codes in their own column. Yeah, I'll just try that. Okay, so this is the change over the 5-day window, which doesn't tell us much. It's kind of just generic. We can group by the offset and look at the difference, and then do this. This is for all dates. So in general, they're going up before, going down over the date, and then reverting. This is about 1 basis point movement on either side. Still may not be telling us that much. So now we can go into the plus or minus surprise. And we'll do the same thing. So this looks really noisy. When it's a positive surprise, I'm just going to make sure I show this one. It's a positive surprise. It was going up in the day before, which we wouldn't have known at the time. Then, oh man, it's dropping. I thought I was using B days. Oh, these releases are always on Friday. Fair enough. Overall change by offset, same thing but splitting it apart. We're getting most of this pattern in here. So yeah, if it's on a Friday, then the next day change is, Monday, Tuesday, Wednesday, and it diminishes somewhat. And then here we're seeing, hey, if it's a negative surprise, it went up in the day before. But you wouldn't have known that in the moment, so I don't know if that's useful. I guess what is useful is, no matter what the expectation is, also consider, I guess, these releases are on a calendar, so if you're looking at, this is every Friday and these are 3 days before, then you're seeing the same economic numbers here from a different grouping by a different thing. Okay, so I don't know how useful that was, but that code may be useful later. What else are we going to do? DTE. We'll do the same thing. So this is when it's a positive surprise, grouping by the days to expiration. Yeah, it looks like 2 years out or so. Hang on. This is... Oh, because this isn't getting all of the days. Fuck. I could group by both, but then it might come out kind of dumb. Let's see what happens. I can reduce the number of cuts too to oops. Okay, so this is positive surprise, short end. Up then down, long end, less reaction. Looks like here the long end reacts slightly more than the short end. So maybe there's something there, I don't know. Here's a negative surprise. Short end is up going into it, no reaction. Short end up going into it. We can also do this and just look at the overall path with no filtering. Up then down, up then down, up then down. Yeah, I'm not really getting any super obvious stuff out of this, so I'm gonna move on. There's another analysis I saw that looked pretty cool. I don't know if I should do it or not. I'll just fucking go for it. Okay, so what am I doing here? I just want to plot the NFP figure versus the contract price. This may come out kind of wonky. Let's see how it goes. Oh yeah, that's horrible. Let's filter the outliers in here. Okay, so here I was just looking at, can we see any pattern between the absolute number and then the price of the contract. I saw a guy do this with calendars, and it was very interesting. May have been with CPI, because that number is more, representative of an interest rate, or an interest rate figure. It kind of matches up with an interest rate figure. So here I'm looking at the absolute figure. I'm really throwing out all the outliers, otherwise it would be just kind of tough to look at. This is looking at like all of our contracts though, and the front end should be different than the back end, right? So here I'm separating those out. Also I'm looking at, here I'm looking at this is surprise instead of the raw change. So I could actually do this. Go px last. Now I'll have the crazy outliers. We'll go like this. It's still hard to read. The outliers. So this is air quotes normal. The lighter one is the back end, and then the pinker one is the short end. So again, this could also capture a trend, where we're just in an environment where the rates have been going up through this data set. So yeah, the pink one will naturally be lower, but even with that in mind, I think it's showing a steeper line for the earlier ones, or no, the later ones. Shit. Anyway, here's surprise, no filter for outliers, just the not much to see there. This one I forgot what I was doing. It's outliers, then surprise, but just the surprise number, not standard deviation. Anyway, so that's a couple ways to look at this stuff. Another one I want to look at. Hang on just a second. Last one I want to look at for this stage is the difference in what is it? Yeah, the forecast average. Whether it's going up or down, basically. Also, the standard deviation could be great to look at. Let's just look at them. So when Trump was elected, there was a big bump, and the standard deviations also went up. Another thing worth considering is that all this stuff has been kind of already mined for information. Gotta move that around, but shit. Okay, here's a more simple way. So if the forecast has gone down since the last one, which I don't know, that's really relative. Like, you could use the forecast up or down from the last number, forecast up or down since the last forecast. It's just more stuff to look into. Then the surprise sign, it's not really filtering for the big or the larger small ones. If it's down and it's down, then not much change. If it's down, then it's up, then these go down a lot. Because things are way better than expected. Then if the expectation is good but the results are bad, it's down marginally. And then if it's up and the surprise is up, then it's even better. I don't know if this is the greatest analysis. I don't know. I'm trying to think about the forecast is already what people are thinking, how people are positioned. The surprise sign is versus that. So I don't know. It's reasonable. It'd be great if we saw something like, hey, when the surprise is opposite, there's a big effect. And these are going down on average over time. So there's that trend to consider. Could try actually detrending this stuff. That would be very interesting. Okay, frickin' finally. Hang on. Just gonna give this a shot. So one of this kind of has look ahead, this does not. I'm just trusting GPT's code. Yeah, now what were we doing before? Now I have to do this whole thing again. Yeah, so it's probably time I put this into a function. Okay, I have to remind myself what I'm doing. It was factor out trend from overall data and do analysis. Demo on super change. Okay, so we still have this. So reg is just offset equals 0. And then we're going to drop yeah, I'll actually use this. Shit. Not too hard to get the days to expiration like this. It's a hell of a lot easier actually. Okay, now I think what we have to do is remember to set our index here. Cool. Now what do we do with this? We'll do the same reg thing. I'm seeing very, very little difference. Just want to make sure I'm actually looking at the right thing. It's reg 1, we have that change, reg 2. This change is different. Here's the original one, looking at the price change of the stirs. There's reg 1. Looking at change. Oh, this is only 60 days out of the entire data set. Also, this is only looking at the day of, so it's just capturing the main change. Okay, this is a reasonable result because it's only 60 days out of the whole thing, so there shouldn't be that much difference anyway. I guess that's great for confirmation, but yeah, spent a lot of time on that. Okay, I guess that's unnecessary. Maybe for more higher frequency stuff it would be better. Anyway, so now there's a bunch of stuff to look at. The results were kind of inconclusive. I would rule out the trending issue, because it doesn't seem to be that much of a problem. So I would take this info a little bit more. It would be more useful. The regression on this data specifically, I don't think it's great, but on other data might be interesting. This was not the most interesting, but want to keep it there in case other data is useful. Okay, so the next thing I would do is clean this up. Hang on. Okay, so I made a new data frame. I'm not going to request new data. I'm going to read in the old data and just toss some of this old stuff that's not as interesting. Ah, shit. Don't need to do that. Don't know if I'll do this here. It may not be important. Now what I want to do is go through the different things here and just run the same sort of analyses on all of them, but it's kind of a shotgun approach, which it's probably better to look at them one by one. here is when we select the data. This forward stuff, will I still do it like that? I prefer not to do it like that. But in here, what are we doing? This is still useful. I would still do this. So, yeah. There's probably a better way to do this, where I just melt the thing like before and then apply the TTE, so I'll actually go ahead and try to do that. Cool. So, Okay, and then in here, I may want to do the same thing here with the differences, but this seemed to be a better way. Okay, so now we have all of our economic data and all of our stir stuff with the main with a raw price. Just want to make sure this isn't the period date. It looks like it's... Oh, it doesn't... Oh, yeah, it has the release date. Okay. Okay. this is really bad. Okay, now we are getting somewhere. I'm gonna skip this stuff and look at it like this. It's renaming it to price. That's why. Okay, so this is some kind of PMI thing. Overall change, I'm focusing on the mean. Basically, it doesn't change much around PMI. When it's positive change, when it's negative change, I don't see much crazy difference here. And it looks messy, so I'm going to ignore. Another PMI, kind of messy, ignore. Another PMI. One of these is ISM. PMI. I think this is home sales. Okay. Okay. I'm going to just do a really quick scroll. NFP. That's what we looked at before. This actually looked similar to another thing, so I think it may be a case of things being released on the same day. Yeah, this CPI is looking the same also. That is very suspicious. Yeah, these are actually coming out the same. That's really suspicious. It's because I'm not doing this. Okay. Let's go like this. Pretty messy, this one. I would trust results like this a little more than this one. PMI messy. Home sales is kind of interesting. Looks like it's a Friday release. NFP. NFP. What did we look at with NFP? Yeah, now this one's looking more messy to me now that I look at it again. The fact that this sums out to 0, but lower standard deviation, it's kind of like just nothing's happening before NFP. CPI. The fact that this is way after CPI, I don't know, I guess this must be another data release or something that just lines up with the same time. Looking at the different CPIs, one issue with this is that it's kind of summing up the same amount of values and it's a low sample size, so no matter what fuckery you do, it's gonna kind of give you like different random stuff, but all within the same small sample set. ESL total, I don't remember what this is. Looks kind of messy. CPUP, I don't know what that is. Industrial stuff, I don't know. Can't remember what this is. I think this might be a home release thing. Housing number. PCE. Huh. I'm going to focus on the sum here because there's a low number of samples here. It must be some kind of holiday issue. Focusing on the sum though, it looks like, wow, these things go to the moon on PCE every single time. When it's a positive surprise, they go up. It's a negative surprise, not much, kind of drifts down after. This one I kind of like the most out of all of them, although they're not all of them are that great. If I could line these numbers up better, that'd be nice. But this one I like it because there's like a clearer, relatively, positive value here, and then a clearer, relatively negative value here, but this is 3 days after, so I'm gonna trust less the numbers further out. Also, the numbers before it, you have to kind of discount these before it because you wouldn't really know what the surprise is. You can look here if there's an overall effect though. ADP. It's looking like it usually runs up into ADP. Drifts down, but this is noisy. Then with a positive surprise, it goes down. With a negative surprise, it goes up. This is a little nicer as these go. And ADP is before NFP, so if I don't know how this works exactly, but if NFP is this one, it should be a quarterly number, so I don't know. I guess this is multiplied by 8 contracts or something, or more. The GDP overall is kind of noisy, and it's a very infrequent number. This might be some kind of PCE or something. It has no negative surprises, it's weird. This is trade balance. So there's this weird spike right before it. This number, I don't know if this is actually monthly or what. Or quarterly, don't really know. One interesting, oh wait, never mind, yeah, these are basically all negative. So I discount these a little bit. I don't know what this random spike is, but that's pretty weird. Yeah, this is a quarterly number, so that actually is annoying because I heard there's other quarterly effects with stirs where maybe banks will bid it up. I did read that though in some data sources, in some readings that were from a decade ago, so that may or may not exist anymore. Another thing to look at. Yeah, but overall, I'm not so stoked about much of this analysis. Most of it is kind of noisy. The DTE thing is also something to look into, and I would still run the regressions. That might be a nicer way of looking at it. So I will try that later. Just put a note to myself. Right through functionalized regression plots. I make this look weird, then it's harder for me to ignore or miss. That's what I'll do when I come back, but to recap, I'm looking at a bunch of stuff with stir, and I'm going to be releasing some various stuff as I finalize it, but just to get started, I'm kind of live streaming a work in progress idea. Probably most of this I will toss because it was kind of a non-result. Like, I did this with NFP at first, and it just kind of looked like just don't trade around them. And in general, these models I'm looking at, they kind of show, when you think about it, you want to be trading divergences when the market's just got these, you know, they push in a direction that's like an overreaction. If anything, these events are probably driving it back toward reality and are more of like, you don't want to exit a trade that you entered before, but I don't know. Yeah. Thanks for checking this out, and cheers.